Are you sick of losing money before the month ends? Ever wondered how certain people effortlessly manage their finances and build wealth? This video introduces the ultimate toolkit, the 8 best money management hacks. These financial techniques will change your budgeting and investing habits. Are you ready to manage your money and live your dream life? Jump in and learn how. There are times when efficiently managing your finances can feel overwhelming, but it doesn't have to be that way. You are able to take charge of your financial situation, invest properly, and save more money if you employ the appropriate tactics. In order to assist you in achieving financial success, here are 8 of the most effective money management hacks out there. Number 8. Create a budget and stick to it. The establishment of a budget is the fundamental component of efficient financial management. To acquire a better understanding of how your money is being spent, you can start by keeping a record of your income and expenses for a period of 1 month. You should divide your expenditures into 2 categories: those that are essential like rent, groceries, and utilities, and those that are not essential such going out to eat, entertainment, and hobbies. By making use of this information, you can create a budget that is both realistic and practical. This budget should distribute monies to fulfill your essential needs, while also setting aside money for savings and spending on anything you like. Not only does this methodical technique assist you in comprehending your financial routines, but it also draws your attention to areas in which you can reduce your expenditures and increase your savings. Maintaining adherence to your budget once it has been established is essential to achieving success. You should conduct regular reviews of your spending to ensure that you are adhering to your budgetary constraints and making adjustments as required. With the assistance of budgeting tools and applications, you will be able to keep track of your finances in real time. Keeping to your budget demands discipline, but it also provides flexibility. If you spend more than you could afford in one department, you should make an effort to compensate for it by cutting back on spending in another one. When you stick to your budget on a continuous basis, you will be able to cultivate better financial habits, steer clear of debt that is not essential, and make steady progress toward achieving your financial goals. Number 7. Automate your savings. The process of automating your savings is a straightforward yet effective method that will ensure that you continuously put money aside without even giving it a second thought. Create a monthly transfer from your checking account to your savings account, preferably at a period that coincides with your paycheck, and set it up to happen automatically before you have the opportunity to spend the money. This pay-yourself-first strategy puts your savings at the forefront of your priorities. Numerous banks and other financial institutions provide capabilities that allow for the automation of these transactions, which makes the process more streamlined and straightforward to administer. It is possible to gradually increase the amount of money you have saved over time if you make saving a non-negotiable component of your current financial routine. The capacity of automation to eliminate the need for decision-making and temptation is one of the most attractive aspects of this technology. If you have savings deducted from your paycheck automatically, you will be less likely to forget about the money or to spend it on impulse. Number 6. Use the 50/30/20 rule. A simple and useful strategy for handling your money and striking a good balance between saving and spending is the 50/30/20 rule. This rule states that you should set aside 50% of your income for necessities, 30% for extracurricular activities, and 20% for debt repayment and savings. First, set aside half of your salary for necessities like utilities, groceries, rent or mortgage, insurance, and transportation. These are the expenditures that are essential to preserving your quality of living. Subsequently, allocate 30% of your earnings towards non-essential spending, encompassing dining out, entertainment, shopping, and leisure activities. This part of your income lets you enjoy life and treat yourself without jeopardizing your capacity to make ends meet. Lastly, allocate 20% of your income to debt repayment and savings. This involves making payments on any outstanding bills, including credit card and loan balances, as well as contributions to your emergency, retirement, and savings accounts. Setting savings and debt reduction as your top priorities creates the foundation for long-term stability and financial security. Number 5. Pay a high-interest debt first. Setting high-interest debt as a top priority when managing debt is essential to reaching financial independence and long-term cost savings. Payday loans and credit card debt are examples of high-interest debt that frequently have outrageous interest rates that, if ignored, can mount up quickly and become too much to handle. You can hasten your trip to debt-free living and reduce the amount of interest you accrue over time by concentrating on paying off high-interest debt first. Make a list of all of your current debts and the interest rates associated with each one to start. Determine which debts have the highest interest rates because you will be paying the most in interest on these. Once you've determined which of your obligations have high interest rates, use the majority of your available income to paying these down while only making the minimum payments on the remaining loans. Take into account employing techniques like the debt snowball approach, which entails paying off the smallest debt first and then moving on to the next smallest obligation, or the debt avalanche method, which prioritizes the debt with the highest interest rate while making minimum payments on the others. You may reduce interest costs and free up more money to work toward reaching your financial objectives, like as creating an emergency fund, saving for a significant purchase, or making investments for the future. By concentrating your efforts on paying off high-interest debt first, you can take charge of your debt and open the door to a better financial future if you are committed to it and practice discipline. Number 4. Take advantage of employer retirement plans. Making the most of employer-sponsored retirement plans, like a 403 or 401k, is one of the best strategies to safeguard your financial future. These plans have several advantageous features, like as tax breaks and employer matching payments. You can save money for the future and receive free money in the form of company matches when you contribute to your employer's retirement plan. Over time, these employer matches can greatly increase your retirement savings. Furthermore, pre-tax contributions to these plans usually lower your taxable income and enable your investments to grow tax-deferred until retirement. You can increase your long-term financial security, reduce your tax obligation, and accumulate a sizable nest egg for retirement by making the most of your employer's retirement plan contributions. Number 3. Track your spending. A key component of good money management is keeping track of your expenditures. This will give you important insights into your spending patterns and assist you in making financially responsible decisions. You can obtain a clear picture of where your money is going and spot areas where you might be undersaving or overspending by carefully tracking your costs. Whether you use spreadsheets, budgeting applications, or handwritten diaries, you may prioritize your financial goals, create realistic budgets, and make necessary modifications to stay on track by keeping track of your expenditures. Additionally, it gives you the ability to choose wisely how much money you spend, which promotes better financial awareness and control. Tracking your spending is a crucial habit that may have a big impact on your finances over time, whether you're paying off debt, saving for a particular purpose, or just trying to get better with money. Number 2. Build an emergency fund. One of the most important aspects of financial stability and readiness is setting up an emergency fund. An emergency fund acts as a safety net for your finances, giving you a buffer to pay for unforeseen costs like auto repairs, medical bills, or job loss without having to take out high-interest loans or empty other savings accounts. Make sure you have enough money in your emergency fund to withstand any unexpected financial storms by aiming to save 3 to 6 months' worth of living expenses until you reach your goal amount. Start by putting aside a certain percentage of every paycheck that is designated for your emergency fund. Number 1. Invest in your financial education. Financial education is one of the best investments you can make for your future. Personal finance education might pay off in the long term when it comes to money management. There are many books, podcasts, online courses, and seminars on budgeting, investing, taxes, retirement planning, and more. You may make smart judgments, find ways to build money, and confidently navigate the financial world by studying and staying educated. Thank you for watching. If you found these money management tips helpful, don't forget to subscribe to our channel for more insightful content on mastering your finances. Hit the subscribe button and turn on notifications so you never miss out on our latest videos. See you next time.